Becoming rich like Warren Buffett requires a combination of financial acumen, strategic thinking, discipline, and patience. While it's important to recognize that replicating Buffett's success exactly may not be feasible for everyone, there are certainly principles and strategies that aspiring investors can learn from his approach. In this comprehensive guide, we'll delve into the key aspects of Warren Buffett's philosophy and investment strategies, along with practical steps you can take to potentially build wealth over time. Part 1. Understanding Warren Buffett's philosophy. 1.1 Background and biography of Warren Buffett. Warren Buffett, born in 1930, is one of the most successful investors of all time. He built his fortune primarily through investing in undervalued companies and holding onto them for the long term. Buffett's journey to wealth is characterized by his adherence to certain principles and strategies, which have been widely studied and emulated by investors around the world. 1.2 The value investing philosophy. At the core of Warren Buffett's approach is value investing. This involves identifying companies that are trading at prices below their intrinsic value. Instead of following short-term market trends, Buffett looks for businesses with strong fundamentals, sustainable competitive advantages, and competent management teams. By investing in such companies and holding onto them for the long term, he aims to generate superior returns. 1.3 Emphasis on quality and long-term thinking. Buffett places a strong emphasis on investing in high-quality companies with durable competitive advantages, also known as economic moats. These are businesses that can maintain their market position and profitability over the long term, despite competition. By focusing on long-term value rather than short-term fluctuations, Buffett seeks to avoid the pitfalls of market speculation and capitalize on the power of compounding. 1.4 Importance of patience and discipline. Another key aspect of Buffett's philosophy is patience and discipline. He famously once said, "The stock market is designed to transfer money from the active to the patient." Buffett's investment approach involves thorough research, careful analysis, and the willingness to wait for the right opportunities. Rather than chasing quick gains, he advocates for a patient, long-term mindset that allows investments to grow over time. 1.5 The Berkshire Hathaway story. Warren Buffett's investment vehicle, Berkshire Hathaway, has become synonymous with his name. Originally a textile manufacturing company, Berkshire evolved into a conglomerate holding company under Buffett's leadership. Today, Berkshire Hathaway owns a diverse portfolio of businesses spanning various industries, along with significant equity stakes in other companies. Buffett's skillful capital allocation and long-term perspective have been instrumental in Berkshire's success. Part 2. Principles of Warren Buffett's investment strategy. 2.1 Fundamental analysis. Central to Buffett's investment strategy is fundamental analysis, which involves evaluating the intrinsic value of a company based on its financial statements, competitive position, industry trends, and management quality. Buffett looks for companies with strong balance sheets, consistent earnings growth, high returns on equity, and sustainable competitive advantages. 2.2 Margin of safety. Buffett emphasizes the importance of a margin of safety when investing. This means buying stocks at prices significantly below their intrinsic value to provide a cushion against unforeseen risks and market fluctuations. By purchasing stocks at a discount, investors can reduce the downside risk and increase their potential for long-term returns. 2.3 Long-term orientation. Warren Buffett is known for his long-term investment horizon. He believes in buying and holding onto quality companies for years, if not decades, allowing their intrinsic value to compound over time. Buffett famously quipped that his favorite holding period is forever, highlighting his commitment to businesses with enduring competitive advantages. 2.4 Concentrated portfolios. Despite holding a diverse array of businesses through Berkshire Hathaway, Buffett's personal investment portfolio is relatively concentrated. He prefers to invest in a handful of companies that he understands well and believes have strong growth prospects. By concentrating his bets in his best ideas, Buffett can allocate capital more efficiently and capitalize on his highest conviction investments. 2.5 Avoiding speculation and market timing. Buffett advises against speculation and market timing, arguing that it's impossible to predict short-term price movements consistently. Instead of trying to outsmart the market, he focuses on the underlying fundamentals of businesses and their long-term prospects. By staying disciplined and avoiding the temptation to trade frequently, Buffett minimizes transaction costs and maximizes the power of compounding. Part 3. Practical steps to build wealth like Warren Buffett. 3.1 Educate yourself. Begin by educating yourself about investing principles, financial markets, and economic concepts. Read books, articles, and reputable sources of financial information to deepen your understanding of how to analyze businesses and make informed investment decisions. 3.2 Develop a long-term mindset. Cultivate a long-term mindset and resist the urge to chase short-term gains or react impulsively to market fluctuations. Remember that wealth accumulation is a marathon, not a sprint, and focus on building a diversified portfolio of quality investments that can grow steadily over time. 3.3 Start early and invest regularly. Start investing as early as possible and make it a habit to invest regularly, even if it's small amounts initially. The power of compounding works best over long periods, so the earlier you start investing, the more time your investments have to grow. Set up automatic contributions to your investment accounts to ensure consistency. 3.4 Diversify your portfolio. While Warren Buffett advocates for concentrated portfolios, diversification is still important to manage risk. Spread your investments across different asset classes, industries, and geographies to reduce the impact of any single investment's performance on your overall portfolio. Avoid putting all your eggs in one basket. 3.5 Conduct thorough research. Before investing in any company, conduct thorough research to understand its business model, competitive position, financial health, and growth prospects. Analyze key metrics such as revenue growth, profit margins, return on equity, and debt levels. Look for companies with sustainable competitive advantages and a track record of generating shareholder value. 3.6 Invest in what you understand. Stick to investing in industries and businesses that you understand well. Avoid complex financial instruments or speculative assets that you can't evaluate confidently. Warren Buffett famously advises, never invest in a business you cannot understand. 3.7 Stay patient and disciplined. Be patient and disciplined in your investment approach, especially during periods of market volatility or uncertainty. Avoid making impulsive decisions based on fear or greed, and stick to your long-term investment plan. Remember that successful investing is about time in the market, not timing the market. 3.8 Monitor your investments. Regularly review and monitor your investment portfolio to ensure it remains aligned with your financial goals and risk tolerance. Rebalance your portfolio periodically to maintain diversification and adjust your asset allocation as needed. Stay informed about economic trends, industry developments, and company-specific news that may affect your investments. 3.9 Seek professional advice if needed. Consider seeking advice from a qualified financial advisor or investment professional, especially if you're unsure about certain investment decisions or strategies. A trusted advisor can provide personalized guidance based on your individual financial situation and goals, helping you navigate complex investment choices with confidence. 3.10 Focus on continuous learning and improvement. Finally, embrace a mindset of continuous learning and improvement as you pursue wealth-building opportunities. Stay curious, open-minded, and receptive to new ideas and perspectives. Keep refining your investment knowledge and skills over time, drawing inspiration from successful investors like Warren Buffett while adapting strategies to suit your own circumstances and objectives. Conclusion. Becoming rich like Warren Buffett is a journey that requires a combination of knowledge, discipline, patience, and a long-term perspective. By understanding Warren Buffett's investment philosophy, principles, and strategies, as well as implementing practical steps to build wealth, you can potentially increase your chances of achieving financial success over time. Remember that there are no guarantees in investing, and success may vary depending on individual circumstances and market conditions. Stay focused on your goals, stay disciplined in your approach, and stay committed to the principles of value investing for long-term prosperity.